Hello traders. In this educational video, I'll be sharing 9 most powerful reasons why a trader should actually backtest a particular trading setup before he or she deploys real hard-earned money on it. Let's start the video. And the first most basic point is historical validation. Now, backtesting allows you to evaluate how a trading setup would have performed in the past. This provides insight into the potential effectiveness and the real market conditions, giving you an idea of its reliability. Now, what does it mean? This means like if you have a particular trading setup, say consisting of few moving averages or few price action tools or maybe few indicators, whatever it is. Now, if you are just making a trading setup on the current market scenario, you do not have that much of sample data, which means the price on which you can actually have the confidence that this particular trading setup might be working in the future also. But if you can actually backtest a trading setup on historical data, maybe for 4 years, 5 years, which is minimalistic required, and maybe if you can backtest it for 10, 11 years, it's the best, then you will be able to understand how a trading setup has performed in a really great bull market, in a very bad bear market, and even a range bound or a choppy market. So you'll have the confidence to actually trade it in the real market scenario. Let's go to the second point. Now over here, if you can see over here that I have two different moving averages plotted on the chart. Below I have a 14 period RSI. Let's assume that if the green moving average crosses the blue moving average, we have a buy setup, and when the green moving average closes below the blue moving average, it's an exit. Now in this scenario, the trading setup has given you a real good amount of money, and somewhere over here it has captured a decent run up on the downside, and again we have a beautiful uptrend. So if you are backtesting a particular trading setup, say for example in the last 2 years, 2023 and 2024, it will give you false impression that the trading setup is amazing and it is giving you a lot of money. Why? Because in the last 2 years it was a beautiful bull market for many of the indexes and stocks. But as soon as you go in the past where possibly you have choppy markets, you can say like 2018, 19, or maybe even 2022, you can just go and look at the Nifty, you will understand. Over here, if you can see the same trading setup in the previous slide where it was working beautifully, over here it is, not working that well. It is having multiple stop losses. Even the trends which are captured on the downside and on the upside are very, very small. So if you have a particular trading setup, if you backtest it for a longer period of time and it has some shortcomings, then probably you will be able to work on it, make it a little bit better, and then eventually start trading it in the real market scenario, right? Next point is risk assessment and performance metrics. Now, risk assessment. By analyzing past performance, backtesting helps you understanding the risk associated with the trading setup, including drawdowns, volatility, and potential losses. Now, over here, one should understand that, friends, every trading setup will have a different percentage of negative drawdown, different amount of consistent stop losses in a row, and different amount of consistent wins in a row. The higher the amount of wins, the higher the strike rate, the lower the negative drawdown, the more confidence you will have on the trading setup, and possibly you can deploy more amount on a particular trade in a system. But if the drawdown is higher, the consistent amount of stop losses are higher, the drawdowns are higher, then you should understand to be able to trade that particular trading setup for a very long time, maybe for decades, you will need to reduce your position size on a particular trade which is going to pop up in your trading setup, and you should also reduce your leverage. Only then you will be able to elongate your trading career. Now, performance metrics. Like over here, what I'm mentioning is you can generate performance indicators such as factor, win rate, risk reward ratio to objectively assess how well the trading setup is expected to perform. Now, in case if you have a trading setup which is looking really good on the charts, once you backtest it and you understand, say for example, a trend following setup generally will have a strike rate of between 45 to 55%. But if a particular trend trading setup does have a strike rate between 45 to 55%, but if the risk reward ratio is very low, say for example, if it just has 1 is to 1.5 or 1 is to 1, then possibly that trading setup is not a very good one, because the reason is, if your strike rate is low and if your wins, the trades where you're making money are not yielding you a very high profit, maybe you will not be able to trade it for a very long time. The risk reward ratio in trading setup where the strike rate is low, the risk reward should be very, very high. And if you have a trading setup where the strike rate is extremely high, maybe 70% or higher, then risk reward ratio over that does not matter. All right. So this you will only come to know with the help of backtesting. Going ahead, realistic expectations. Now, this, my friend, is a very, very big point. Over expectations. Now, sorry, many traders, when they start their trading career, I believe they have extremely high expectations from trading. I can understand that trading is a very, very lucrative business, but you should also understand the more realistic expectations you will have from a trading setup, the higher the chances of success you have in trading. Because say for example, if you are expecting that if you are going to double your money every 3 months or 4 months or maybe in a month or whatever expectations you have, but if your trading setup is giving you an X number of return on a given year on an average, you will not be able to surpass it. And if you try to do so with a higher amount of leverage or a higher position size, you might damage your trading account due to negative drawdowns and also due to fear. The reason is you will have fear is because when you're taking higher leverage, it will automatically not allow you to trigger your stops, because in a particular trade, when the stops are getting triggered, since you have deployed a higher amount of account in a particular trade, that particular stop loss will be very, very high in terms of amount. And generally there are many people, like there are two types of traders. One is who is extremely brave, who has over expectations. One another type of trader is who is always afraid of losses. I think as a trader, you should understand that over expectation is also going to not help you to make a lot of money, and fear will stop you to make any amount of money. So if you backtest a particular trading setup, you understand, okay, this is the strike rate, this is the maximum drawdown which I can have in my future. Yes, it can be exceeded, but not a lot. And if you have a trading setup which will give you around say 25% returns at the end of the year, you will have realistic expectations. How will you be able to make money in the next few years? Now, all of us know that there are different type of markets. A bull market, which everyone loves, a bear market, which no one likes, and the third one is choppy market. Now, a good trading setup will generally be able to trade and make money in all three trading markets. Okay, if you are a long only trader, if you are only looking to go long in the cash market, and you are trying to avoid a bear market, then a good trading setup will allow you to exit all of your long positions before the large correction starts. Okay, in 2025, when you saw the market correcting, no one will be able to predict the top. But at least when the initial fall started, if your trading setup has allowed you to exit a lot of positions which you were holding in the cash market portfolio, as a medium term trader for 1 month to 6 months or for a year, then maybe your trading setup is good enough. But if you don't have an exit strategy, and in a falling market, if you are losing all of your money which you have earned in a bull market, then probably you need to work seriously on a trading setup. Similarly, if you are a swing trader, if you are a short term trader where you're trading in derivatives as well as cash market, then your trading setup should give you profitability in a bull market, in a bear market, and even in a range bound market. Yes, in a range bound market, the profits will be lesser The amount of stop losses might go a little bit higher, but still I would also tell a good trading setup will not kick you out of the market when the markets are completely choppy and range bound. So a good trading setup should allow you to survive in all these three market scenarios. Going ahead, the most important one is psychological readiness for all three markets. Now, as I told you that we have three different type of markets, if you simulate the past market conditions, like if you just see last 5 years, I would say 2020 was a very bad year at the starting because we had that COVID correction. Then suddenly we had a U-turn, we had a bull rally in 2020-21. Then 2022 was a very choppy year. Then again 2023 and 2024 were phenomenal bull rallies. And again 2025 till now, so far, it looks a bad year for cash market traders. So by simulating the past market conditions, you will be mentally prepared that what sort of emotional challenges you are going to face in trading if the next 5 years or 10 years are going to be a mixed bag, like few years will be bull runs, few years will be bear markets, and maybe a couple of years will be a taste of choppy and range bound markets. So you'll be able to understand how much volatility you can have in your trading portfolio, whether you are a cash market or a derivative traders, and how the system reacts to different market scenarios, which will help you to deal with emotions like fear and greed. Going ahead, position sizing. I believe this is the most easiest way to reduce risk. Why? Let's get into it. Through backtesting, you can test different position sizing methods for different trading instruments like cash market, options, and futures, and find out a safer way of allocating funds to manage risk. This helps in determining the right amount of capital to allocate for the trading strategy. Now, here you should understand that different trading instruments will require different position sizing. Now, what is position sizing? For beginners, position sizing is nothing much but how much risk you are trying to take per single trade. For me, I would say that for a particular trade, I should not be losing more than more than 1% of my trading account. So if your account size is say just 2 lakh rupees, a very small trading account, then you should not lose more than 2000 rupees per trade in any given market scenario. If your portfolio size, if your trading portfolio size is 20 lakhs, you should not lose more than 20,000 in any given trade, whether it's a derivatives trade or a cash market trade. So any particular trading setup, generally in bull rallies, you will see when the volatility is low, you will have higher win rate, you will have stop losses which are smaller. In a bear market scenario, you will see money if you are a swing trader or a momentum trader, but the sizes of your stop losses in terms of percentage will slightly increase. Again, in a choppy market scenario, the returns will come down, and at the same point of time, you will also see the amount of stop losses will be slightly higher because the trends are very small and they are not that much defined. So as a trader, you will be able to understand what sort of position sizing will be proper for your particular trading setup when you have a sample of backtested data in front of you. All right. Time efficiency. Now over here, we should understand that if your trading setup is not that great, maybe on paper it's looking amazing, maybe the amount of work you have put in formulating a particular trading setup, I completely agree and I completely respect to it. But suppose if your trading setup in a backtested data, if it is showing, just for example, you can see over here in the charts, like in 2022, it's giving you a return of maybe 15%. 2023, it's a bull rally, it's giving you maybe 35%. In 2024, where it's a blow off rally, it's giving you maybe 45%. So you see 3 years of consecutive rise in profits and you're very happy. But suddenly in a bad year like 2025, suddenly your portfolio drops but minus 20%, which clearly means then in a bear market scenario, or maybe not a bear market, I should say, in a scenario where the markets are falling very badly, you are losing a lot of profitability which you have earned in the last 3 years. This is not a good sign. A good trading setup, even if your trading setup is only a long only trading setup, you should not lose a lot of money which you have made in the last few years in the bull rallies. Yes, you will lose a little bit here and there, but it should be controlled. If you're losing a large part of it, then maybe you need to work on it. And this you will only come to know with the help of a back-tested data. Yes, the back-tested data will not give you the exact percentage of drawdown which you will have, but abruptly, you can say approximately, you will understand how much negative maximum drawdown you can have in your trading portfolio, and this will help you to allow to tweak your trading setup a little bit before you put in your real hard-earned money. All right. Now, avoiding over optimization. Now, this is where I believe I think many of the beginners make a lot of mistakes. Even I have done a lot of mistakes in my career. Now, when you're making a trading setup, you should be very, very open to this particular thing, robust. A trading setup should be extremely robust in nature. It should be tradable on different asset classes. It's like if you say that your trading setup works on Nifty, but it does not work in Bank Nifty because it's very volatile, then I'm pretty sure that your trading setup will not work in the future. Not futures trading, I'm saying in the upcoming years. If you have a trading setup which is working on Nifty, then it should work on Bank Nifty, it should work on stocks, it should work on cryptocurrencies, or maybe even abroad markets or abroad stocks. Also, it should be logical in nature. Logical in the sense is, if you have a trading setup and if you can understand why a particular trading setup is giving you a buy signal, why it is giving you a sell signal. It should not happen that, okay, on the chart you just found out a pattern, and whenever that pattern is getting repeated, you can make a lot of money. But you don't know and you don't understand why that pattern is coming up on the charts. Well, then I can tell you pretty surely that once that pattern stops coming, your profitability will also stop. So as a newbie or even as an experienced trader, I would tell you that your trading setup should be logical. You should understand why your trading setup is giving you a buy signal, why it is giving you a signal to book profitability, why a stop loss is getting triggered, and why you need to exit a negative trade. So again, now backtesting is a very good thing to do, but what is over optimization? Over optimization is like, say for example, if you have backtested a particular trading setup on 2023-24. Now both these years were bull rallies. Now there could be a particular parameter on a particular tool or an indicator, say a moving average, say an RSI, and that particular parameter or RSI is working perfectly in 2023 and 24. But as soon as you go to 2022 or 2025, those parameters are not giving you profitability. This means that that particular trading setup is curve fitted on a sample data of last 2 years. So that is the reason I have been repeating in this particular video that your trading setup should be profitable for at least minimum last 5 years to 10 years. And suppose if you're making a trading setup on stocks or even on index, make sure that your particular trading setup makes money on other asset classes as well. Maybe it will not make or work that great as it works on Nifty or stocks on which you have made it, but it should be still profitable and it should have those similar indications that it has X number of stop losses or X amount of profitability at the end of the year and that much of strike rate. Say for example, if you're getting a strike rate of 45 to 55% on Nifty or stocks, and suddenly if you go to cryptocurrency and gold, suddenly your strike rate drops to 15%, then something is really not going right with your trading setup and you should have a look at it. So this is what I'm trying to make you understand in this particular slide. Let's go ahead. Now this is the final and the most important one. Why we are doing backtesting? The main reason is when you are going to start trading a particular trading setup with your real hard-earned money, you should understand that you could be a very good trader, you could be a very good analyst, but if you do not have confidence in your particular trading setup, you will not be able to execute trades in times when markets are not very friendly to you. When markets are trending, when markets are going up, you might be able to make money. But if you did not had any idea that how a particular setup is going to work in a falling market, and suddenly after 2 years you have a string of losses, you suddenly see all the profitability which you earned, 40-50% of that has been wiped out, then there is a very high chance once you see this, you will not have confidence in that particular trading setup to test, to trade it further. On the contrary, if you have backtested a particular trading setup, you know that in a falling market, initially you will lose a little bit amount of money. But if the market continues to drop further, at least your trading setup will stop giving you buy signals. And if you are a derivatives trader, it will also give you short signals on the downside. Then you will have a much higher confidence to trade that setup with your real hard-earned money. And at last, I will only tell you, my friends, that you are going to put your real hard-earned money, which you have earned with a lot of blood and sweat. Please respect yourself, respect your hard-earned money, respect your time in the markets, and see that you are not over here to get rich overnight. See that your trading career elongates over the next few years and decades. Try to get rich slowly rather than immediately. All right. So I hope you enjoyed this video. You learned a lot from it. And if you learned a lot from it, try to share this video with other traders as well. And also let me know with your comments below. How did you find the video? Trade less, trade wisely. Thank you.